And good morning. Like all good things, you need a little technical difficulty to figure this out. So, one, hopefully everyone can hear me. And two, I hope you can join me live here this morning while we talk about the Seattle Metro. And we're going to talk about data, where the market's headed, what's specifically happening inside of the market. And if you can hear me, drop me a comment because this is live. So I just want to make sure that this is actually happening right now. Okay, let's look forward into 2025. I went and dug through a bunch of data for you. So who am I? My name is Anton Stetner. I've been in real estate since 2003. This is my 21st year in real estate. We've sold thousands of homes, mostly in King County and Snohomish County. I live at the north end of the metro here. I went to school to be a biochemist. I love numbers, data, patterns, how things work together. Own a couple brokerages, real estate investor, and just been doing this a long time. So I want to share with you my thoughts. Thank you, Molly, for saying good morning. I appreciate that. So at least I know someone can hear me. And what I want to go through real quick with everyone is like, what do you need to know about the market? Like, what things do you need to pay specific attention to so that you're prepared for 2025, number one? And number two, where's the whole Seattle Metro going? What are these numbers going to look like later this year? And I'm going to show you a piece of data here in a second to explain what I mean by that. But when markets slow down, people assume that prices are going to drop. What we've seen happen is we've seen the transaction count drop. Next, we want to talk about rates matter. Rates throughout this market have shown us very specifically that when we are above 6.5%, the market slows down significantly. When we're below 6.5%, the market starts to pick up. We just saw this most recently with rates getting down to basically like 6.11. And then the Federal Reserve, they come in and they cut, and then rates shot up, and we got almost as high as 7 again. Well, what happened to transactions? Transactions started slowing down. So I want you to watch the 10-year Treasury. The 10-year Treasury is what all 30-year debt is based off of. And we'll take a look at the 10-year Treasury. I'm typing it in uh, over here on my other screen so that we can take a look at that here in a second. Where's the 10-year Treasury going, and what's that mean for us? Because most residential debt, all of the real estate market is following or mirroring what's happening with the 10-year. Number four, once the Fed starts cutting rates, what usually happens? Once the Fed starts cutting, we see the Fed then continue to cut over the next 1.5 years. So, yes, it takes time. Yes, it's massively slower than you want it to be or I want it to be. I want the good deals to happen now. The last thing I want you to be thinking about or you need to know is that building permits and development applications throughout the Seattle Metro are down. What that means is we have a lack of future supply. So that lack of future supply, what is that going to do for us? That's going to put pressure on rents, and it's going to put pressure on prices. And now we're going to go through some more of this data. The Federal Reserve has started changing their tone if you've been nerding out and paying attention like I have. Before, they were talking about inflation, inflation, inflation. And now all of a sudden they're talking about unemployment, unemployment, unemployment. Why? One, they feel like they've started beating inflation. Two, and I believe they actually have beat inflation. When you look at the last inflation reading from CPI, yes, it came in hot. Yes, PPI came in a little bit hot. But when you go through and strip out the data, the lagging metric for shelter, because shelter is measured over a 12-month period. So it's like 12 boxcars on a train and it all rolls together. When you take that out, inflation's actually already below 2. So the Fed probably feels like they've hit their target. That's why all they're talking about is unemployment, unemployment. The problem with unemployment is as unemployment starts to rise, if it breaks too quickly, what happens is it literally goes off a cliff. So we'll be watching unemployment, watching how the Fed reacts to that, because that's not going to affect us just nationally. That's going to affect us here in the Seattle metro. The next thing I want you to be paying attention to is consumer confidence, consumer spending. Is the consumer still spending? We are a consumer-based economy. So if the consumer's not spending, our economy is not rocking and rolling. Next, GDP. Is the economy growing? Is it moving? What's happening? Last, kind of your geopolitical events, major economic events, both in the US and outside the US that affect us, and conflicts. Are those conflicts turning into full-blown wars? Are we being drug into them? Because this has the ability to affect our real estate market nationally and locally. As I go through all this stuff, everyone, feel free to drop into the comments your questions, what you're thinking, what you're feeling. This is always for you as we give these predictions out, but I want you to interact and I want you to tell me what you're thinking or what questions that you have. Okay, so what do we need to watch locally? Because this whole live is about the Seattle metro. What's going to happen to real estate here? So the big question is what's going to happen with unemployment and major employers? Boeing is on strike. And if Boeing is on strike, that's greatly affecting Snohomish County. They say for every one job in Boeing, that's affecting 5 other local jobs. If that strike continues, that's going to put pressure on housing prices and housing demand. Well, what else is happening locally? Well, we're being affected nationally. What are we being affected by? We're being affected by the political election. Yes, the stupid presidential election is causing fear, uncertainty, and doubt because people don't know which direction it's going or what's going to happen. So when the consumer doesn't know, what they do is they reach down and they hit that pause button and they just hold on. What's that mean for hardcore investors like me, like you, some of my listeners? It means that right now is deal season. You need to be hunting. You need to be making offers. So, what I want you to look at from a metrics perspective, though, is let's be watching the number of new listings. So, as inventory rises or the number of new listings coming on the market changes, then you need to know, is that affecting supply? So, look at number 4 right there. See where it says months of supply. Months of supply is the available inventory. If months of supply starts massively rising, if new listings start massively rising, if the percent of original list price starts going down and days on market starts rising, that's an indicator the market is slowing. Conversely, if the opposite of that happens, it's the market speeding up. So one thing to be thinking about right now in this latter part of the year is seasonality. During the latter part of the year, days on market naturally rises, but new listings slow down even though inventory may rise because there's less demand. Molly, you just asked a phenomenal question, like, should buyers wait until after the election? I believe that fundamentally the president is not going to massively impact the real estate market immediately. Now, over the long term, absolutely. Based on their taxation policy, based on rates, based on the economy, they totally can. But in the near term, if I'm waiting till after the election, what I'm actually saying is I want to pay more for real estate. I want to go make offers when everyone else feels comfortable. See, Warren Buffett told us a great quote. He said, "Be fearful when others are greedy, and be greedy when others are fearful." The political election is putting, the presidential election, excuse me, is putting a lot of fear into the market. So I would say right now is the time. And once again, everyone, drop your questions. Love having these conversations with you. So, months of supply, we talked about that. Percent of original list price. What is the percent of original list price? Percent of original list price, if it's 98%, which is about the average here in the Seattle metro, is it means if something was on the market for 100 grand, it sold for 98. In other words, it came in about 2% less. As that number rises or gets to above 98, you know bidding wars are happening. As it gets above 100, it's telling you the market is massively on fire and hot. So, as a buyer or an investor or a seller, you can be looking in zip codes, in cities, in specific neighborhoods to see how hot it is based on that percent of original list price metric. Okay, Dom, days on market. Days on market's talking to you about the velocity on the market. And then last, we have sales price. So let's, here we go. So hold on, I want to pull this off. Here we go. So I went through and I nerded out in the data. I went and played with the data. I went and looked over the last 10 years so we could look at predictions over 2025. I dropped a lot of this data into ChatGPT and I just sat there and manipulated it over and over again. If you're not using one of these AI platforms to do homework, to speed up your thinking, to ask amazing questions, you are going to get left behind in the real estate industry. I'm telling you now, don't be the boomer in real estate. Get on the bandwagon. Stop using Google. Stop using Bing. Stop using Brave. Just use these AI tools. They're phenomenal. Okay, so where are we going in 2025? Let's take a look at where we've been to figure out where we're going. So I went and looked at the last 10 years in King County. And the last 10 years in King County, this blew my mind. The average annual increase in price has been 8.4%. Holy Toledo, that is a huge number. So, knowing that it's been 8.4%, let's look at where we're at this year. And so now I'm going to share a different screen, present, remove that one, present, share screen, InfoSparks, share. There we go. This is the entire MLS. What happens if we project this out over 10 years? So, what I did was I went in and I dropped a trend line onto this data. When they're looking at these things is if I'm an investor, if I'm a home buyer, and I appreciated 8.4%, that also doesn't include debt paydown. That doesn't include the tax benefits, the interest write-off, and if I'm an investor, the depreciation. So this is why we sold our out-of-state investments, and we're bringing all of our money home to the Seattle Metro exactly right now, because we believe, and I believe these predictions are gonna show you, our listeners, our subscribers, if you haven't subscribed, subscribe. Freaking hit the subscribe button, hit the like button, and share this with someone that needs to see it. But we sold all of our properties out of state. We're bringing it home. Why? We believe the greatest opportunity over the next 3 to 5 years is right here in our backyard. So then what actually happened to average price in King County? It started at 487,000 and it's almost 1.1 over a 10-year run. And you can see most of these years we did phenomenal. 2019, not that good. But then, bam, because of COVID, you got a huge uptick in 21. The Fed raised rates massively in 2022. So you had the small increase in 2023, and then boom, another 10%. So this is where the rubber meets the road. And this is probably the most important part of this prediction. If the trend line continues, the average price in December of 2025 is going to be 1.265 million in King County. If it's 5% greater, it's going to be 1.328. If it's 5% less, it's going to be 1.2. Any way you look at that, that's win, win, or win bigger. Okay, let's continue on the data. Well, let's look at it from the median perspective. So is the median is the middle. Average is add them all together, divide by the total. Median's the middle. So the average can be affected more, but the median's going to be a little smoother. It's going to move just along with the middle. So the median over the last 10 years, and once again, we dump this data and then analyze the data, was 8.61. Here's the last 10 years. It started at 397 up to 860,000. The same trends are showing up. Same problem in 2019, same dip in 2023 versus 2022, with 2024 coming back with a vengeance. Okay, let's get myself with, if we stay on trend, the median price at the end of 2025 will be 915,000. The high side 961, the low side 870. Once again, still really high. So next we're going to dig into Snohomish County. If you have questions or want to look at some data specific, we can go through and do that. But I just wanted to make sure that we're going over these numbers with you. And if one of you wants to jump on, just like Zoom, and have this conversation with me, you are more than welcome to. Snohomish County, same thing. Average price up 9.72% over the last decade. Let's 919, and 5% below, 831. For perspective, just so we're on the same page, the average price in September 2024, I've got it up on my other screen right here, 809,657. That's a lot of equity that we're still building in the face of high rates. So I want you to be asking yourself a question. I'm showing you trends based on high rates. If rates go lower, do you think that these trends could go higher? Do you think that we might hit that upper end, that upper 5% limit? And so when you say, as an investor, I want to wait, or a buyer, I want to wait, or a seller who's planning to move up or move down, you have to realize that right now the data is showing us, it's predicting for us that the whole Seattle Metro is simply going to cost more in 2025, and not just a little bit, a lot more. We're talking 9 to 12% more. Now, some of my friends say, you know what, Anton, you usually sandbag on this. And so when someone says, how much can we expect? I'm still going to tell you 7%. Why? Because the data knows I can hit that expectation. My dad told me when I was young, we need to underpromise and overdeliver, and then do everything we can to meet or exceed people's expectations. But this data blew my mind when we got it all up and into these slides. Okay, let's look at the median price. 9.3%. Holy Toledo over the last 10 years. Let's look at the trend. I got to look it up over here on the screen. In May of 2024, the median price in Snohomish County, excuse me, not May, in September, it's September. In September, 749,950 is the median price right now. And so we're predicting that that median price is going to go up, by another almost 50,000. Actually, I guess that's more than 50,000 next year. So this is where I get to say thank you for watching. Actually, hold on. Let's not do that yet. Let's reverse for a second. Let's go through what can affect this. I want to go through interest rates, and then I want to go through these predictions so we're all on the same page. So I'm going to show you the 10-year Treasury, and then I'm going to go through how it could be higher, how it could be lower, and then what to watch for. And then how I'm personally going to capitalize on these trends in order to, make really good money here in the local metro. So present, I need to add to stage. Oh, we got it. Look at that. Okay, let's make this a little bigger. Look at that. Okay, 10-year Treasury. So the 10-year Treasury, look way back here. Okay, way back here, 0.65. This is during the ZERP era. It's less than 1%. This is when mortgage rates were 3.5, 3, 2.5, 2.75. And then the Federal Reserve starts raising. So realize all real estate debt mirrors and matches the 10-year. So what does Anton do on a daily basis? I'm not joking. I wake up, I look at the 10-year Treasury, and I look at the trend. The trend is your friend. That's something we talk about a lot in real estate. We talk about a lot in fitness, in health, in wealth, that you got to look at things over a longer term, a longer time horizon, and look at how the trend is working. So year to date, we started the year lower. Okay. This is when interest rates were about 6, 6.25. Boom. They raised last year in the beginning of this year. Right here is when the Federal Reserve started talking about cutting, and boom, it plummeted. Here's the Federal Reserve's actual cut is somewhere like right here, and then it shot up. Everyone keeps asking, why did it shoot up after the Federal Reserve cut? Because the market had overbaked in the Federal Reserve's cut. Stock market, bond market, they are future predictors about what they believe is going to happen. So they already baked it in. It rose back up. It's probably hitting a top right now, and then it's going to slowly float back down again. But rates are not going to come down quite as fast as I want and quite as fast as you want. So that's going to create opportunities. If we're watching the 10-year and you see it flex up, no, it's going to cause buyer demand to go down. If you see it go down, it's going to cause buyer demand to go up. That should maybe be times for you to make offers as an investor. Think about selling your home. So that one's that. Let's go over here to the stats for King County, and we're going to drop it down to the last 3 years. So what I want you to see here, what I'm trying to show you here is buyers, there's a seasonality. Investors, there's a seasonality. When do things cost the least? During December. Why? Here in the Seattle metro, it rains a lot. And when it rains and it's yucky out, we buy and sell less homes. It's just that simple. So, what do I want you to be watching? One, the 10-year treasury. I want you to be watching our national economy. I want you to be watching unemployment. Locally, the stats I want you to be watching is active inventory, days on market, percent of original list price, months of supply, because this will show you the neighborhood you're playing in, where it's going. It'll show you where that city is going, where that zip code is going. If anyone has any specific questions or about where they think the market is going in the future, drop it into the chat. Happy to answer them. Or if you want me to look at a specific zip code or a specific city, I'm happy to do that for you too while you still have me. But I also want you to ask the question, what happens? Let's go through a couple scenarios. What happens in a no landing scenario? So the Federal Reserve has talked about this no landing. That means the economy does okay. And we have this idea of a rolling recession that goes out throughout and just hits different sectors. That we continue this thing I'm calling a K-shaped recovery. Yes, this is an ugly K, where those with assets go up and those without assets go down. The market's going to treat you unfairly because of inflation, because of assets, because of too much money printing over the next few years. So my advice is buy assets, because from a show of hands, yeah, I'm used to speaking to people publicly. That's funny. You can drop in the chat. Who feels like inflation is pinching them right now? Like groceries are expensive. Rent's expensive, houses are expensive, construction materials expensive, labor's expensive. It's all expensive, and that's going to continue. So the only way to protect yourself is, one, do everything you can to lower your expenses and raise your active income. And then number 3, buy assets. In an inflationary environment, assets protect you. What was the next thing I was gonna say? Oh, yeah, and regardless of the political election, the presidential election, what that's going to do is that may just determine taxes. One is a little bit more pro taxes, Kamala, and one is a little bit less or against taxes, Trump. Less taxes, and he is a real estate guy, is probably good for real estate. We just recorded a whole podcast episode about that. That's going to come out next week, where we do a deep dive into each one of their political positions and how we think it works for real estate. But the moral of the story is whoever gets elected, you have to semi shift your strategy so that you're maximizing your future potential based on what the government is doing to you. In other words, they're going to give you a playbook, and I want you to simply operate by that playbook. One thing that's really helping us here in the Seattle Metro, regardless of the president, regardless of the economy, and I know this sounds crazy, is the fact that it's so hard to get a building permit. If any of you have gotten a building permit or done a land development in the last year or two, drop it in the chat if that was easy. I'll be honest, we do a bunch of it. I love land development. I love building and construction. And we've got 17 of our own projects going right now. I can tell you over the last 20 years, that process has become longer, more expensive. It's required more experts. The level of code and understanding of the code of this esoteric, weird language. So it's making it so the average investor, the average ma and pa can't go get their own building permit or can't do a land development application. And here in the Seattle Metro, we got the Cascades over there. Okay. So we got a wall of giant mountains over there. And then we got the salt water over there. So we're pinched on both sides. So we're pinched by geography, number one. And then we took this thing called the Growth Management Act, and it came out in the 90s. It was designed to control suburban sprawl. It's why most of the future development and the current development is happening up and down the I-5 corridor, on 405, on I-90, on 167. It's happening on these major corridors. And it's happening there because that's where they allowed the zoning to happen. Well, the Puget Sound Regional Council, which controls these 5 counties right here, so the majority of the thick part of the population, they basically voted to not bring in any more buildable land. So one, the amount of buildable land available for subdivision didn't get significantly increased. Two, what you're seeing is you're seeing an upzoning. But three, we know that currently land development applications and permit applications are down, which means regardless of the economy, less supply is coming for me and you, which is going to artificially force up prices. So do I feel comfortable saying the market's going to appreciate here in the Seattle Metro 7% next year, 8%? Absolutely. That would be right on trend. Do I feel comfortable saying we might get 10? Yeah. But if interest rates go down significantly, like for example, if interest rates get to 5.75, 5.5, that could significantly unlock the start of marginal demand, the marginal buyer. It could start to bring that move up seller back in. For those of us that are licensed, that means that we could sell 10 to 20% more homes next year. So what do we need to do? Think of this like we're still in a little bit of trials and tribulations, and the ocean is still rocky. I need you to get on your surfboard. I need you to paddle out through the waves. And for those of you that have done it, to paddle through the waves, you actually have to dive down through the wave and push through it. Requires effort to push down through and up through the other side. But you need to get out there and wait for the good waves because they're coming. It's starting. You can see it in the data. Because if the Federal Reserve has already started and rates are trending down, we know that we're going to most likely sell more homes and we're most likely going to get higher appreciation than all the data I just showed you. And so I want to say thank you for hanging out with me. Here's my contact information. If you can subscribe and share this with someone else and send me an email and or a comment, Molly, I appreciate you. And I totally agree that we are going to get pinched by the market and the lack of supply. But that pinching is the opportunity. That is the massive opportunity for everyone is that lack of supply. And I'll close with this. We just said this at the winning series our office put on. I believe your biggest opportunity is in middle housing and in the ADU DADU bills. We have other videos on the channel about this, and we're currently practicing what we're preaching, where you're going to be able to build more units on lots or small 1,000 square foot units in the backyard, and in a rural area up to 1,200 square feet. And I think that's the biggest opportunity. I think this is the biggest opportunity I've seen in land development and new construction since I started in it in the early 2000s. I'm Anton Stetner. Thanks for hanging out with me. I appreciate all of you.